And ultimately, we really just don't know when that recession will come. There's a lot of things that are different about this time versus what we've seen in the past, whether that's corporations terming up low cost loans early on and may have 3 or 4 more years before they have to refinance at higher rates, or most of the American public being locked in on 30-year fixed rate mortgages at 3 or 4%, whereas new home buyers are at 8%.
Well, welcome to the fourth quarter edition of Barnes Quarterly. We were just sitting here talking that it's hard to believe that, but this is the 17th edition of Barnes Quarterly. So we've been doing this for a little over 4 years. Time's flown by. But we have a special treat here today. Chris Zaccarelli is actually here in the office with us on site. So we'll be getting his comments a little bit later on. But we're launching into the holiday season with Halloween a couple of days away. And Eddie, of course, is here with me, and he's probably a little more tuned into this holiday than I am these days because he's got 3 little ones at home. And so what are the hot costumes for this season, Eddie?
Yeah, you've always got to figure out what neighborhood is passing out the best candy and plan your trick-or-treating around that. It seems like the costumes change every day. Last I heard, it was going to be the Addams Family that my daughter was really excited about and was planning, all the costumes for the rest of the family. But who knows what it'll actually turn out to be when we get there.
So you're going to be Gomez Addams.
Who knows? Like I said, it could change every day. I don't know that I would fit the bill of Gomez. Probably Fester a little bit better.
We're gonna get some mileage out of this one. But at any rate, it's been a nice fall. We've actually had a hint of some cool weather, although it's warmed up recently. One of the big talks of the town around here is the FSU football team, and they're obviously off to a great start this season. And we'll see how the second half of the season shapes up. But they're a far cry from where they were a couple of years ago, and we're happy for that. One thing that we have been busy with around here is Eddie participated again this year in the Hang Tough skeet shooting competition out at Talon. We did pretty well last year, came in second. I, of course, was not shooting, so that's how they were able to come in second. But at any rate, we're happy to support Hang Tough. They're a great local charity here in the area. As far as other happenings around the office, it's pretty much been business as usual, but Eddie is off to a conference up in Boston that's being hosted by John Hancock.
Yeah, it's just a good chance to get up there and kick the tires a little bit and hear some of the new offerings that they've got coming down the line and see how we can better serve some of our retirement plan clients.
We do use Hancock for our 401ks primarily, but they also have got some great mutual funds as well. So it's always good to go do a little due diligence with some of the investment providers that we use. So as far as our discussion of the markets today, there obviously have been a lot of news items that have impacted the volatility, the stability, or lack thereof of the markets. Everything which the ongoing discussion of inflation and how far the Fed is going to hike, or are they going to pause, or are they going to taper off? We've got a couple of global conflicts going on in Israel and the continuing troubles in the Ukraine. We have a UAW strike going on that's affecting our automakers. We have a House of Representatives that can't seem to find a leader. And so all of these news items have got impact on movements in the markets. I've got Chris here who's going to give us a little more perspective on that and hopefully calm people down a little bit. But despite all the negativity out there, the hype that the media seems to be spreading, the news from the performance of the markets year to date is actually pretty good. Probably the standout is the NASDAQ, which we think of as the smaller growth companies, but that particular index is up 24.9% as of this past week. But the S&P 500 is up 11.5 again year to date as of last week, and so there obviously is money that can be made in markets like this, but I think you probably have to select your spots a little more carefully. And I'm going to turn it over to Chris to sort of bring things into focus and maybe give us a little more insight.
So 2023 has turned out to be a pretty positive year for the stock market in terms of the indices going higher, but really it's been a tale of those large mega cap companies. So whether that's Apple, Amazon, Microsoft, Google, Facebook, etc., those companies have really been driving the indices. And so the NASDAQ is up so much because such a large percentage of that index is made up of those companies. And the S&P has not quite as large a weighting, but a similar impact from those companies. So you do have some really big companies driving the market. If you look at the Dow Jones, which is close to flat or only up 1%, it really shows you the impact that those technology companies have had within the S&P and the NASDAQ. So it's been more of a challenging year than you would expect just based on the surface level. But in general, a lot of people heading into 2023 thought the market was going to be down for the year. So the fact that we're up even at this point, despite all the headwinds you mentioned, is really is a good thing.
So there's been much made of the fact that the bond market has obviously had as far as the interest rate moves that we've had, that's had significant impact on the performance of the bond market, which people typically think of as sort of a safe haven. But could you comment a little bit on sort of what the current situation is and what the outlook is for the bond market?
So, you're exactly right. A lot of people think of bonds and stocks as moving in opposite directions, and that's typically the case. Typically, when you see the stock market going down, it's because there's concerns of recession or concerns about economic instability, and typically people take money out of the stock market and put it into the bond market. This year, the problem has been, and for the last couple of years, the problem has been inflation has been the real story. So inflation going higher, the Fed raising interest rates, that's hurt the stock market, and that's also hurt the bond market because all things being equal, higher interest rates from the Feds will drive bond prices down. But in general, that relationship should reassert itself at some point, and we're getting close to that point because with yields around 5%, at some point bonds will really hit their low price for the cycle, and then typically you'll see bond prices going higher when the stock market goes lower. So that's a relationship that at least for the last year or two hasn't held as well as it has for the last 40 or 50 years. But I'd expect that to reassert itself, once we get a reset in levels, which we're pretty close to.
Chris, I mean, this is always a point of conversation, and I know that our listeners have probably heard us talk about this in the past, but, I do have some account holders, some clients that, say, well, if CDs and money markets and short-term treasuries are paying me 5%, why don't we just cash everything in and go to one of those instruments that's going to pay me a for sure 5% rate of return until things settle down, and then we'll move back into the stock market.
Well, the problem with that and really any type of market timing is you just never know when the market's going to reverse. It can always go a lot lower and it can always go a lot higher. If you look back to March of 2020, the stock market fell 34% in just a few weeks. And then all of a sudden it was back to even within a couple months. And by the end of the year, it was even higher. So typically when you find that things have settled down or that you feel like now is a good time to get back in, you've missed the entire move. So rather than taking that risk and trying to decide, what might be the bottom, what might be the top, the better course of action is typically to have a good plan, one that you can stick with through good times and bad. And by sticking with that plan, when the unforeseen happens to the good as well as the bad, your portfolio should react accordingly. And ultimately, we're trying to capture the 5, 10, 20-year moves in the stock market. It's very, very hard to capture a 1 day or 1 week or even 1 month move. And so that's why I'd advise pretty strongly against that idea of trying to market time, when to go into a money market or when to come out of it.
Yeah, and it wouldn't take long to neutralize that 5% gain that you had on CDs if you missed the uptick in the market, correct?
That's right. I mean, it could happen within a day, but it typically will happen within a week or two. It can be pretty fast.
Chris, depending on the day and depending on who you're listening to, you'll get expectations or prognostications that are all over the board. Some are saying recessions are coming down the line, and some say that it might take a while before something shows up. What are your thoughts on what we're likely to see in the near future?
Yeah, so I think that's a great point. Depending on who you talk to or listen to, you can really hear a lot of differing opinions. And at the end of the day, no one really knows for sure. I think it was pretty commonly believed at the end of last year that we would definitely have a recession in 2023, and we're a couple months away, and it seems like that's not going to be the case. So I think in prior cycles, just the fact that the Fed would raise interest rates would cause a recession. And there's no reason to believe that won't happen this time. But what is a little bit different is how long it's going to take. So if it takes a year or 2 or 3 years to cause a recession from higher interest rates, I think that's a completely different scenario than if one came within 6 to 12 months of after they raised rates. And ultimately, we really just don't know when that recession will come. There's a lot of things that are different about this time versus what we've seen in the past, whether that's corporations terming up low cost loans early on and may have 3 or 4 more years before they have to refinance at higher rates, or most of the American public being locked in on 30-year fixed rate mortgages at 3 or 4%, whereas new home buyers are at 8%. So it's really anyone's guess when the Fed rate hikes will take effect. I think at some point they have to take effect, and so we can't ignore the fact that the Fed raising interest rates as high as they have, as quickly as they have, won't have an impact. But I think it's really difficult to say that it'll happen right away. At least from what I've seen within all the economic data, it doesn't seem like a recession is going to be happening in the immediate future. But you'd have to be wary about the fact that it will eventually happen for sure.
The hikes in interest rates that we've had over the last year or two haven't seemed to quite have that strong of an impact, I guess, as maybe potentially they wanted it to. Do you foresee them keeping rates pretty steady for the time being and hoping things catch up to that, or do you foresee potentially more rate hikes coming to try to force the hand?
So from what I've seen with the Fed, clearly they've been fighting inflation the only way they know how, which is raising interest rates. Lately, they've all been talking a lot about the other side of raising interest rates. So everyone knows that raising interest rates, in theory, can slow the economy down, and that can contain inflation. But also, if you raise rates too high, you can cause a recession or cause a steep downturn. And the Fed has started talking a lot more about two-way risks. So when I start hearing them talk about two-way risks as opposed to just raising rates, it makes me think that they're pretty close to done raising rates. They're supposed to be meeting at the end of October for a November 1st decision. I feel pretty strongly that they're going to leave rates unchanged. Whether or not they raise rates one more time in December remains to be seen. I would say if the data continues the way it's been coming in, and clearly with the conflicts in Israel and Ukraine, as Stan mentioned, it's likely that they keep rates on hold yet one more time. So I think the Fed has moved away from raising rates as much as they can to holding rates steady at a much higher level. So I think people underestimated how high they would go, and now they're at 5.5%. And I think people now are coming to terms with the fact that they may hold that 5.5% rate for 6 months or longer. So really it's going to be the current level for a longer period of time, not necessarily an unending string of rate increases.
Given that they're potentially going to hold rates longer, and potentially this being the bottom for the bond prices, do you see yourself shifting to more of a fixed income weighting in your portfolios?
So as far as equities versus fixed income, I try to keep that independent of what we're doing from an investment point of view. That really, to me, matters a lot more on the individual person. Some people are good with 60% equities or 70% equities. Others would be at 40% equities. So I'd be less inclined to move what percentage is in equities or fixed income, but I absolutely would adjust what's in the fixed income portion. So for a lot of the last couple of years, we've had what's called shorter duration bonds in our portfolios, those that mature in a shorter period of time. And that's helped insulate us somewhat from the interest rate movements that we've seen. However, once you start to get to those bottom prices, the best thing you can do for your bond portfolio is extend that duration. So start buying a little bit longer dated debt. And so I have been making some of those changes within the portfolios, not because I necessarily know when the bond market has bottomed, but it's almost a dollar cost averaging approach where as you're approaching some of the better prices that we've seen in years, start to take advantage of that and little by little take some moves in that direction.
Well, Chris, as always, we really appreciate you being here for us and with us today here in Tallahassee. We got some nice weather for you while you've been here, but really appreciate your insights and your guidance with our clients. I'll just wish everybody a happy holiday season. We'll be looking in the rearview mirror at Thanksgiving and Christmas for our next podcast, but hope you all are healthy and safe throughout the holidays, and we'll be back very soon. Thanks.
Chris Zaccarelli of Independent Advisor Alliance are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.